What if I told you that the most sophisticated credit makers on Wall Street operate like a bunch of dudes trading in a back alley, with no transparency, no liquidity? You can't even see the price unless you pay $25,000 a year for a Bloomberg terminal. Well, Michael Saylor just blew the door off that world.
4, 3, 2, 1, go. You're only supposed to blow the bloody doors off.
And at the same time, revealed the financial innovation that may break it forever. Let's dive into the section of the interview with Michael Saylor and Grant Cardone to get to the bottom of this.
And then we tried convertible bonds, and we did $10 billion, and they were successful. But at the end of the day, they weren't going to scale
because
they trade over the counter. It's illegal for a retail investor to buy one.
Jesus.
Back to all these securities laws, they're 144A issues. So that means you have to have $100 million of capital, being a qualified institutional buyer, and they trade over the counter. And over the counter is it's a polite way, it's a euphemism for, 32 dudes trade with each other with one broker in the middle. It's like a
Diddy party to me.
It's like a bunch of guys meet in the back alley, in the corner, and they all trade with each other in the back alley, and there's a bid-ask spread, and there's no trades for the last 18 days.
In other words, Wall Street built a market where only insiders can play. Retail is locked out. Transparency doesn't exist, and the credit being issued, completely mispriced. That's the real kicker.
And you can't get the bid quote or the bid-ask quote. You have to pay $25,000 a year for a Bloomberg just to know what the last trade was. It's too difficult. Mm-hmm. And so what we discovered is they were illiquid instruments, but maybe more importantly, what we realized is they were literally investment grade, like they're 50x over collateralized. So imagine a bond where you've got $50 of capital for every dollar in the bond, and it trades like triple distressed debt going out of business. The credit spreads were like it was a triple junk bond going out of business, but the backing collateral was triple investment grade. And so if someone said to you, I want to be 50x over collateralized and I want you to pay me 20% interest, you're like, that doesn't seem quite right.
Right.
And so we just realized it wasn't good for the issuer. It wasn't even good for the buyers. It only makes sense for the convertible arbitrageurs, but the convertible arbitrageurs, they're not long Bitcoin. They don't want to invest in Bitcoin. They don't want to invest in the company. They're not really even credit investors. They're traders.
So Saylor realized the credit system itself was the problem. And if you can't fix the system, you have to build a new one.
And so we started thinking that we needed to fix the credit. And so we basically traversed from bank credit, asset-backed loans, senior credit, convertible bonds. And we started thinking, why don't we sell preferred stock? And preferred stock is like a bond, but it's perpetual. So I sell you $100 million of preferreds. Means it never comes due. Mm-hmm. I'm going to borrow $100 million. I'm going to pay you 10% dividend a year forever. I'm never going to pay you back the principal. It's equity. And I approve the dividends. If the company can pay the dividend without being insolvent, then the company pays the dividend. But the board is not allowed to pay the dividend if it would render the company insolvent. So you see, if you sell a preferred equity instrument, by definition, there's no credit risk. You can never be in default. You see, if you structure it right, you're not paying back
because it's first in line.
You're not paying back the principal ever.
Okay.
How do you default on that?
Right.
You're not paying it back. Mm-hmm. And the dividend is not a coupon. You can't be in default. You can be in default if you don't pay the coupon on a bond, but on an equity, if you skip the dividend, you might have an obligation to accumulate the dividend and eventually pay it, but see, you're not in default. You see, Not in the same way that you'd be in default on senior debt.
Right.
In senior debt, you pledge collateral, you miss the dividend.
Has this been done before?
People have, preferred stock have been around forever.
Okay.
Yeah, I mean, I didn't invent preferred stock. It's just I invented the idea of putting preferred stock together with digital capital.
Mm-hmm. This is STRK?
This is, the first deal was STRK, Strike, then we did Strife, then we did Stride, then we did Stretch, STRC.
Four this year.
5 this year.
5, excuse me.
Last week we did Stream, STRE. Yeah, we started moving fast.
Dude, crazy.
And so 2025, you said, like, when did we start to take a leadership role? I would say we went from desperation and frustration to being opportunistic, and tactical. And then it was really in 2025 that we really became transformed into a new business. Because
what was the funnest stage of those 3?
Oh, now is the funnest time.
Oh, it is?
Yeah, because now we invented a new business.
Right.
And let me describe the business.
Please.
It's digital credit. Basically, we created a new asset class, digital credit, backed by Bitcoin, which is digital capital. And we created a new business model, digital treasury. So we're a treasury company. We sell securities, we buy capital, and then we create credit instruments. We sell the credit. And the credit, digital credit, is 100x better than conventional credit. Because first of all, it's built on top of appreciating collateral. Bitcoin's going up 30% a year. It's not on depreciating collateral. When you create credit on a warehouse or you create credit on an iPhone 17, these products and services and buildings are, the Rockefeller Center has got a 40-year, 50-year life before you got to do a full rehab, right? Renovation. So you've got appreciating collateral, not depreciating collateral.
Because the second, Bitcoin.
Because it's digital capital, because it's Bitcoin. Because Bitcoin is good for, remember when I told you it's like useful life is immortal?
Right.
What, would you like to build, what if I gave you a building that was maintenance-free, tax-free forever and never rusted?
Please, quit talking like that to me.
It would change the economics of real estate, right?
Everything.
Okay, so that's kind of what we did. We built it on a digital building. Okay, so that was the fundamental. But we did a bunch of other things.
It's debt without the CapEx.
The second thing we did is we created the credit as an equity instrument, not a debt instrument. That means it's an asset on the balance sheet. It's not a liability. Okay. The third thing is we made it perpetual equity. There's no call provision. There's no refinance provision, which means that the people that bought the instrument can't call it back or redeem it. For example, when you're a bank, if I put $1 billion in your bank, you've got the capital, but next Tuesday I can actually withdraw my money, and so you've got the money for 2 days. Bank deposits are temporary capital. If I gave you $1 billion and you gave me a 5-year note, a corporate bond, you've got the money for 5 years, but in 5 years I get it back.
Right.
If I gave you the $1 billion in a preferred that was perpetual, you've got the money forever. I'm not getting it back. So we created a perpetual credit instrument, not just a temporary credit instrument. That's the third innovation.
Okay.
The fourth innovation is that all of the credit was based upon that digital capital, so it's all transparent, homogeneous, real time. You can recalculate the credit risk every 15 seconds. Like, we're 10x over collateralized on Bitcoin. You plug in the price of Bitcoin, the volatility of Bitcoin, the year forecast of Bitcoin, it spits out statistically what is the risk of being under collateralized over the term of the instrument. So that's the third thing. And then we took it public. So we made it public credit, not private credit, which means that there's a ticker, STRK, STRC. It's got a name. You can buy this on Robinhood. It's got a happy name, and you can find it in Australia,
what does
right?
a happy name mean?
What I mean is it's a 4-letter ticker, and it's a name called Stretch. Okay, can you name the 19th tranche of JP Morgan corporate debt?
I cannot.
Can you find it?
No.
It's a CUSIP number. The point is that's private credit. And actually, that's over-the-counter credit. Private credit is, okay, somewhere someone has a loan, from somebody else. So you see, we went public And
That's a new thing. Nobody's done that.
no one ever did that, right? And we listed it, and when we listed it, we attached a shelf registration to it, that ATM. So we were taking these ideas, Bitcoin and the ATM and the preferred and the public, right? And then we're putting the shelf. And why is the shelf registration important? Because that meant that when we sold the billions of dollars of it, if there's demand in the market at 3:55 p.m. on a Thursday for $50 million of this instrument, someone buys it, we sell it, the price doesn't move a penny, we create the $50 million of credit in the next few minutes in real time. So complete digital liquidity, digital creation. Like if I gave you $1 billion and I said, now I want you to go develop $1 billion worth of real estate, or I want you to like scrape together $1 billion worth of home loans,
right,
or issue $1 billion worth of mortgage-backed securities, that takes people and time, and it's heterogeneous. And maybe there isn't $1 billion worth of underlying collateral. So,
or worse, I have to drop down in order to fulfill it. So
you have to
degrade my purchase.
So maybe it becomes heterogeneous, right? The first $37 billion of Chicago mortgage-backed securities you created were this level, but the next $37 billion.
It's going to deteriorate.
Yeah, you know, it's kind of common sense, right? The faster I give you the money, and the harder it is, then the more degraded the credit, maybe the lower the returns.
Yeah.
But you see, with digital credit, it's completely homogeneous, instant, real time, right? What is the quality of the credit? Well, you're backed by $5 of Bitcoin. What about this tranche? This is backed by $5 of Bitcoin. Well, what happens if you slam the market with $27 billion of demand? Okay, now it's backed by $4 of Bitcoin. Your BTC rating went from 5 to 4. Well, how much risk is that?
So BTC is a rating now.
BTC rating is another metric. It is,
crazy, man.
Well, we had to create a credit model. So BTC rating of 5 means
BTC yield.
You have $5 of Bitcoin for every $1 of a liability or a nominal, credit instrument, and common sense says a BTC rating of 10 is better than a BTC rating of 5, right? And so the credit is created instantly. The credit risk is transparent. And that means that the instrument trades with less volatility. So if you look at Stretch, when Stretch gets to $100, we can pretty much peg it at $100 plus or minus 2 pennies because we've got the ATM on it. And that at the market registration means if someone came in and wanted to slam the price to 102, we're just holding it at $100 and 1 penny.
Well, how can you hold it?
Because we're selling the instrument.
You're selling it, so the more you sell.
Yeah, if you wanted to buy $1 billion, if you wanted to buy $1 billion,
if I wanted to go to 102, you would do what?
I would just sell $1 billion at $100 and 1 penny.
But okay, so but how are you controlling it not getting to 102?
We're selling it at $100 and a penny.
You're controlling the price.
We're selling it at a penny.
Got it.
So how's it going to go to 10 cents if I'm selling it at a penny?
Right.
You see, the innovation is...
How are you controlling what it sells for if the market's there?
Well, we're in the market, but if we're willing to sell $80 million worth of the instrument at 2 cents, it's not... Why would you want to pay 10 cents if someone will basically meet your order at 2 cents?
Right.
This is just the way the market works.
Okay.
The point... Let me say it a different way.
Yeah.
If you have a stock and you cannot sell it and everybody wants to buy it, the price goes up.
That's right.
And if you have a security and you're willing to sell $2 billion of it and the average trading volume is 100 million a day and you're ready to sell $2 billion of it, the price is not likely to double or triple.
Yeah.
Right? Because you're making the market. Okay, so the point here is we created a preferred stock. We attached a shelf registration to it. We pay a dividend on it. The dividend is backed by Bitcoin. And because we're willing to create more of the instrument if there's more demand, the price is stable, becomes stable. If we weren't willing to create more, and if there was twice as much demand and we wouldn't sell any, the price has to go up.
Yeah.
But it turns out you don't want the price to be fluctuating. You don't want the volatility.
This guy wants income.
Yeah, and so let's take Stretch. What is Stretch? It pays a 10.5% dividend at par, at $100. Okay, so if you wanted to buy $1 billion of it tomorrow, you don't want to pay $200. You want to pay $100.
Yeah.
So the only way to make sure that you can buy it for $100 is someone has to be willing to sell you $1 billion, and that someone is our company.
Are you going to stay current on that 10% or 10.5?
The way that works is every month we adjust that dividend rate, and if the security is below 100, if it's weak, if it's below 99, we raise the dividend rate. Mm-hmm. And if we ever thought it was too strong, we could lower the dividend rate. But right now, you should think of it as a monthly dividend, 10.5%. And that takes me to the last point I want to make. The digital credit instruments are superior because we pay rates which are double or triple a money market. Like we're paying 10.5%, your money market's paying 4%.
Yeah.
And in Europe, the money markets pay 2 or 1.5%. And the second reason they're superior is because they're return of capital dividends, what we call ROC dividends. Mm-hmm. If the issuer is funding the dividend by raising capital in the market, if we sell equity in order, or we have a business that keeps negative earnings and profit, then any dividend we pay becomes tax deferred to the recipient.
Right. It's like refinancing a piece of real estate.
You see it happen occasionally in the real estate business, occasionally in oil and gas or master limited partnerships. It's not a new idea. Mm-hmm. None of these things I've done, Grant, are new ideas. It's just I put together 100, return of capital tax law from 1910 with the SEC 40 Act, with the ATM from 30 years ago, with preferred stocks, with Bitcoin. You combine it all together, but the result is, if you're a New Yorker, you're getting 10.5% tax-free, and that's a tax equivalent yield of 22%.
Yeah, it's huge.
So it's what we did is we created a digital credit instrument that gives you a tax equivalent yield of anywhere from 16 to 22%, depending on whether you live in Miami or New York or San Francisco. And we created a company, right? We discovered the asset, digital credit, because we wanted to escape the credit risk of bonds, you see, and we wanted to scale the business. It was a necessity, was the mother of invention. Mm-hmm. So we created it. We created it with digital capital and digital intelligence, with AI. We had a clean sheet of paper. We had like infinite money, and we could do anything, and we're a public issuer. So we create the perfect credit instrument. For what? Well, if the issuer wants to sell $100 billion with no credit risk, it's perfect for us. But it's also perfect if the recipient wants to collect billions of dollars of fixed income tax efficiently. It's perfect for them. Who isn't it perfect for? Everybody in the middle, the traditional finance establishment, 20th century banks, 20th century investors, 20th century credit markets, right? We just bypass them and we create something.
Why is it not perfect for them?
Because they sell 144A over-the-counter issues and they trade with each other. It's like there's an army of 10,000 private advisors with Bloombergs that trade with each other that are going to put a 6% yielding bank preferred in your portfolio until you die. Mm-hmm. So the existing 20th century credit establishment, they're selling you stuff that pays you 5% taxable. Okay, well, so there's $300 trillion of that garbage.
Yeah.
Okay, and we're creating something which is 10% tax deferred.
Yeah.
Okay, so it's better, four times better than what the conventional world has. But the winner is the investor, the public investor, the consumer, small business, and the winner is the issuer. And the winner is Bitcoin and the crypto economy, right? Because we're funding the crypto economy. Our shareholders are winning. We're winning. The investors are winning. But we're just disrupting the traditional credit markets. And now my last point, we invent a new asset class, digital credit, and then we discover that as long as the company has cash flow or earnings less than the dividends, We're in a negative earnings and profit situation, which means that we're issuing ROC dividends, or return of capital dividends, which means they're not taxable to the recipient until they sell the underlying instrument. And so that's a discovery, right? That's just another serendipity. You know, if you look at my entire journey, it's like
you're showing up and then you see something.
We did, you know, we tripped over being a WIXI, and we discovered we had a great derivatives market, and we discovered we could sell converts, and then we discovered we could create digital credit, and we discovered we could pay ROC dividends. And so all of a sudden the heavens open, and we see the big picture. Here's the big picture. We're the world's most tax efficient generator of fixed income, and also we're the most scalable one. So what company could basically generate $100 billion of dividends that are tax deferred and grow the business 20% a year? Nobody, other than a digital treasury company capitalized on digital capital selling digital credit with a laser-like focus. And yeah, I would love to tell you, yeah, in March of 2020, I figured it all out. I did it. In March of 2020, I was just irritated, frustrated, and angry and desperate. And it was like, I'm either going to fight or die. And so we went on a journey to fight and not die. And we popped out. Yeah. We popped out having discovered a new business model and a new asset class and a new mission in the middle of 2025. And what I would say today, you say, well, what's the mission of the company? Well, our job is to provide 1 billion people with a bank account that pays them 10% tax deferred. And it's a big idea in the US, but in Europe, they're getting 150 basis points. In Switzerland, they're getting nothing. Right. In Japan, you're getting nothing. So how about give me 10% tax deferred, strip the volatility away, strip the risk away. Just give me a extremely low volatility, low risk way to get paid 10% while I figure out what I'm going to do with my money. And if you boil this down to the entire investor thesis today, I would say, if you have money you don't need for 4 years or longer, and you don't trust anybody, you buy Bitcoin. And I think maybe you get 30% a year for the next 20 years. If you have money you don't need for 4 years or longer, and you're in love with a business model, you know, whether it's digital real estate, whether it's digital credit like my company, whether it's digital intelligence like NVIDIA, then maybe you buy the equity. You know, if you think you can do better than 30% a year, right? And you've got a long time horizon. If you have money you need in the next 4 years or the next 4 weeks, you buy credit. You buy digital credit, ideally, because the digital credit's going to pay you 2 to 4 times more than conventional credit. And the digital credit we're describing probably performs like the S&P index or better, but without the volatility, with more stability, you know. And and that provides a solution for everybody and everybody's pool of capital. And everybody's got some money they need in 4 weeks, some money they need in 2 years, and then some money they want to invest forever and give to different their investors. And you think that through. And that's become very clear to us now. But I would say I probably couldn't have told you that a year ago. All I knew a year ago is we have a good thing, we're going to figure it out.
Saylor didn't break Wall Street. He just built something better. If you want more breakdowns like this, hit subscribe. Share this with someone who still thinks Bitcoin is a risky experiment, because the future of credit is already being built on top of it.